So, monetary policy is another form of demand side policy, and demand side policy just affects aggregate demand. So, it's a tool used by the government to change aggregate demand, either up or down. If it raises aggregate demand to the right, it's expansionary monetary policy, and if it brings it down, then it's called contractionary monetary policy. So, in this regard, it's pretty similar to fiscal policy, but the tools are different. There's two tools, and the first are interest rates, and the second is the supply of money, which is a little more complicated, so I'll get into that later. Because there's different ways that the different means to change the supply of money. So the way interest rates work, the Fed sets or the central bank in a country sets an interest rate, a federal interest rate, and if interest rates go up, it's more expensive to borrow, so consumption and investment fall, leaving aggregate demand to fall. On the other hand, if interest rates go down, consumption rises and investment rises and aggregate demand rises. I'm gonna move through this part quick just because I've already been through it, I think twice now in other videos. So with that, if aggregate demand goes up, real GDP goes up, price levels go up. So expansionary monetary policy is a tool to create growth in the economy, raise employment. Contractionary monetary policy, on the other hand, is used to control inflation by bringing price levels down. And before I get into the most complicated part, the supply of money, I'm just gonna go over the basics of monetary policy, which I should have done in the beginning. So it's enacted by a central bank and not the government itself, not the elected officials or unelected in some countries. And this is positive in some ways because it's quick to enact, there's no gridlock, there's no debate. The central bank officials just decide what to set the interest rates or how to change the supply of money. It's also easy to fine tune again because of the lack of gridlock and debate. The bank just makes a decision and can make small adjustments to the policy, which is harder for fiscal policy. But as any other type of policy, there is a time lag, and there's for expansionary monetary policy, in terms of interest rates, there's also a limitation because expansionary monetary policy will raise interest rates. So the problem there is, or no, expansionary monetary policy will bring interest rates down. So for contractionary, there's no limit to how high they can be raised. If the government sees there's still inflation, they can just keep raising it. But for contractionary or for expansionary, there's only a limit. There's a limit to how low the interest rates can go. So that is a limitation. Expansionary monetary policy involving interest rates can also be ineffective depending on consumer confidence. So if they want to bring consumption up, they can lower interest rates, but if the consumer confidence isn't there, people are not going to borrow. They're not going to make big purchases like cars and homes. So that is another limitation, and it's a pretty big one. Consumer confidence is always a lens you want to look at anytime you're talking about consumption. So there's three ways that the government can change the supply of money. But to better understand this, first I'm going to go through the money market, which is a new graph here on the right. So on the y-axis you have interest rates, and on the x-axis you have the quantity of money. So if the demand of money rises, let's say if there's a new line over here for a higher demand of money, then interest rates will also rise. So you'd have a higher interest rate here if demand goes up. Similarly, if demand goes down, demand for money goes down, the interest rates will fall. But this is not what the government uses to control the supply of money. Actually, let me rephrase that. The other actions, or just forget what I said. It's like 2 a.m. right now. And that wasn't a great way of phrasing things. So onto supply of money. It shifts left or right. So if it goes up, or if it goes up or right, interest rates will fall. So expanding the supply of money is expansionary, and lowering the supply of money is contractionary. So the first and simplest one to understand, in my opinion, for controlling supply of money are called open market operations. And remember that all of this is conducted by the central bank. So in the United States, that's the Federal Reserve or the Fed. So open market operations are just the Fed or the central bank buying and selling bonds. So if it buys bonds, then the money supply rises, which will lower interest rates, and it's expansionary. So this should bring AD up by buying bonds. If it sells bonds, it achieves the opposite effect, and it lowers the supply of money, which is contractionary, and AD will fall. So selling bonds is contractionary, and buying bonds is expansionary. And the way this works, you don't really need to know this for the essay, for any essay that you write. But if it buys bonds from security dealers, by it I mean the central bank. Securities are just bonds. So if it buys bonds from the dealers, then it will supply the dealers that sell government bonds with cash, therefore raising the quantity of money. And if it sells bonds, then it takes in money, removing money from the economy, from the market, therefore reducing the supply of money. The other tool used to control the supply of money is called the required reserve ratio. And if the central bank raises this is contractionary. So the supply of money will fall, and so will AD. On the other hand, AD will go up, and the supply of money will go up if the required reserve ratio goes down. And what the required reserve ratio is, when banks receive a deposit, a percentage of it is stored, vaulted, saved, and a percentage of that money is loaned out by the bank. So the percentage required to be vaulted and saved by the banks is the required reserve ratio. So this here, the percentage that is saved, is the required reserve ratio. And the reason that it going up will cause the supply of money to fall is because then, if this goes up, then the percentage loaned will go down, since they add up to 100%. So anytime the RRR goes up, the percentage loaned will go down. And if there's less money being loaned, there's a smaller supply of money in the economy, in the market. Banks are loaning less, so the supply of money will fall, and that is contractionary. Finally, the last tool is called the discount rate, and the discount rate changes the federal funds rate. I have to get to what both of those mean in a second, so hold on. I can't just jump straight into it. So, in my opinion, this is the most complicated one. What you have to know is that banks, if you're a bank, you borrow from two sources: the Fed, or the central bank, and other banks. And by other banks, I mean just private firms, just other banks other than the central bank in your country. So the discount rate is a rate set by the central bank, and that's the rate that other banks, the interest rate set what other banks have to borrow from the central bank. So if the discount rate goes up, it's more expensive for banks to borrow from the central bank. So this does two things. First, it encourages the banks to keep more money in order to borrow from the Fed, and they can do this. They can keep more money by changing the interest rate on their loans to consumers and firms. And so the federal fund rates, which I mentioned earlier, are the real rates that banks are loaning at each other. So the discount rate affects the federal funds rate. by encouraging banks to keep more money or less money if the discount rate goes down. That one's a bit tricky to explain, and I'm not sure if I explained it in the 100% best way to understand, but either way, I would definitely encourage you to read some more on this. On monetary policy as a whole, it's interesting and there's a lot to understand and tackle. But to summarize this part, so discount rates going down is expansionary, and discount rates going up is contractionary. And any time that the supply of money falls, aggregate demand will fall. Anytime the supply of money rises, aggregate demand will similarly rise. So those are the three tools for changing the supply of money. The first, open market operations, buying and selling bonds. The second, required reserve ratio, the rate set by the government at which banks must store and save money, which lets them loan out more or less money depending on the percentage, and the discount rate, which is the rate that banks borrow from the Fed at.